Hi there. This video is about financial decision. What's financial decision? Financial decision is a decision about money. In a company, this decision can be in terms of acquisitions of assets, financing and raising funds, day-to-day capital and expenditure management, etc. Financial decisions therefore affect both the assets and liabilities of a company. Financial decisions consider cost and benefit. In financial decision, investors should consider that the benefits bigger than the cost. We will see types of finance decision. First one, investment decision, financing decision, dividend decision. Investment decision, a decision which is concerned how the firm's funds are invested in different assets is known as investment decision. The investment decision relates to the decision made by the investor or the top-level management with respect to the amounts of funds to be deployed in the investment opportunities. Investment decision can be a long-term one or short-term one. A long-term investment decision is called capital budgeting decision, which involves huge amounts of long-term investment and are irreversible except at a huge cost. Short-term investment decisions are called working capital decision, which affects day-to-day working of a businesses. It includes the decision about the level of cash, inventory and receivables. Capital budgeting is a part of investment decision. The decision of investing funds in the long-term assets to improve the overall production or servicing capacity of organization is known as capital budgeting. Capital budgeting is the process of selecting the assets or an investment proposal that will yield returns over a long period, and they often require heavy capital expenditure and are always for a long term. These expenditures include establishment of new unit or the expansion of the existing unit, the purchase or replacement of new machinery, investment in research and development, etc. The first step involved in capital budgeting is to select the assets, whether existing or new, on the basis of benefits that will be derived from it in the future. The next step is to analyze proposals, uncertainties and risk involved in it. Since the benefits are to be accrued in the future, the uncertainty is high with respect to its returns. Finally, the minimum rate of return is to be set against which the performance of long-term project can be evaluated. Next, working capital, which comes under the investment decision. The investment made in the current assets or short-term assets is termed as working capital management. The working capital management deals with the management of current assets that are highly liquid in nature. Short-term investment decision also concern receivables and payable as well as acquisitions and use of inventories. The investment decision in short-term assets is crucial for an organization as a short-term survival is necessary for the long-term success. Through working capital management, a firm tries to maintain a trade-off between the profitability and the liquidity. In case a firm has an inadequate working capital, then the firm may not be able to pay off its current liabilities and may result in bankruptcy. Or in case the firm has more current assets than required, it can have adverse effects on the profitability of the firm. Thus, a firm must have optimum working capital that is necessary for the smooth functioning of its day-to-day operation. Next, we will see factors influencing investment. First one, cash flows of the project. Second one, rate of return. Third one, investment criteria involved. Now, we will move to the financing decision. Financing decisions are decisions that are made to ensure the financing of the company. They are related to the raising of equity as well as debt for a company for funding of its investment decisions. In other words, it is decision on the capital structure of the company. Capital structure includes owners' funds and borrowed funds. It is a continuous ongoing process as each company regularly needs funding because the growing companies needs to do not cease, rather go on increasing to keep pace with the growth. Financial managers have to make an important decision in order to form a proper capital structure. The capital structure of a firm is made up equity and debt. They have to work out a perfect balance between two as to maximize shareholders' value and profitability of the firm. Going for high equity capital reduces the tension of repayment as they become part of the firm's own capital. But then, shareholders must receive higher returns in the form of dividends and will lead to the dilution of ownership and voting rights. On the other hand, debt includes loans from banks and financial institutions or debentures, etc. Higher debt increases the interest burden and makes the capital structure riskier. Furthermore, the company cannot rely on this source of finance permanently as lenders can reclaim their money at any time. Any weak period of performance can play spoil sport with the company and put onto the multi-fold pressure. Final one, we will see dividend decision. Whenever a company makes a profit, it decides to reward its shareholders in return for their investment, trust and confidence in the company. This reward is called a dividend. At the same time, manager must make the decision to retain part of the profit for the future needs of the company. This is known as retained earnings. Managers have to make the important decision of how many portions of the profit the company should pay out in dividend and what part they should keep with them. Giving away higher dividends makes the stock attractive or share attractive, increase the market price and the overall market value of the company. But they also have to take into account earnings and their stability, the growth prospects of the company, its cash flow status, dividend tax, and above all its own funding requirements.